Hi, everyone. Welcome to our special edition podcast series, Employee Benefits and Executive Compensation, Preparing for 2026. I'm Constance.
And I'm Jeff. We're excited to bring you this installment of our series designed to help employers stay up to date with key developments in the employee benefits and executive compensation space.
Today is November 13th, 2025, and in this episode, we are diving into mandatory Roth catch-up contributions. This is a crucial topic for employers as we approach 2026, with significant implications for retirement planning and compliance.
That's right, Constance. We'll be breaking down what mandatory Roth catch-up contributions are, why they're important, and what steps employers need to take to ensure they're prepared for 2026. We'll also touch base on the new rules for enhanced catch-up contribution for participants aged 60 through 63. Let's get started.
As everyone knows, catch-up contributions are additional retirement savings allowances for individuals aged 50 and older. A plan is not required to offer catch-up contributions unless there is another plan within the same controlled group that offers them. This is often referred to as the universal availability rule. But practically speaking, most 401k, 403b, and governmental 457b plans allow them. As we discuss the requirements in this podcast, we'll focus solely on 401k plans. We'll assume that the plan offers catch-up contributions and is also a calendar year plan. The application of these rules to a non-calendar year plan are a bit more complex and beyond the scope of this podcast. Today, the IRS issued 2026 cost of living adjustments for retirement plans. For 2026, the annual deferral limit for 401k contributions increases from $23,500 to $24,500. And the catch-up limit for those aged 50 or older increases from $7,500 to $8,000, disregarding the enhanced catch-up contributions for those aged 60 through 63. These limits are subject to annual adjustments, which are typically announced by the IRS in the fourth quarter of each year. So as noted in the introduction, we'll discuss the two following topics. First, starting in 2026, participants with FICA wages exceeding $145,000, which has now been adjusted to $150,000 for 2026, in the prior calendar year can only make catch-up contributions to 401k plans on an after-tax Roth basis, not on a pre-tax basis. Unlike pre-tax contributions, which are tax-deferred until they're distributed, Roth contributions are taxable in the year they are contributed to the plan. The trade-off is that Roth contributions, along with related earnings, generally will be tax-free when later distributed from the plan. Second, 401k plans can now permit participants who are age 60, 61, 62, or 63 during the year to make enhanced super catch-up contributions to a 401k plan for the applicable year.
As Constance noted, the mandatory Roth contributions will be in effect starting in 2026 for plans to offer catch-up contributions. These rules were originally to be effective in 2024, but there was no extension given, although there was hope that the IRS might further extend the deadline beyond 2026. The super catch-up opportunity is optional. An employer was permitted to offer the super catch-ups as early as last year in 2025. Plans maintained under one or more collective bargaining agreements, including multi-employer plans, are not required to comply with the mandatory Roth contributions rule until the first taxable year after the later of December 31st, 2026, and the date of which the last collective bargaining agreement related to the plan that is in effect on December 31st, 2025, terminates without regard to any extensions. Employers generally must follow a good faith interpretation of the rules for 2026. Final regulations, which we'll discuss today, do not go into effect until 2027, even later for collectively bargained plans. Taxpayers, however, are permitted to rely on the regulations before 2027. Generally, 401k plans must be amended by December 31st, 2026 to implement the Roth mandate. The final regulations also clarify that if an amendment applies mid-year, is not a prohibited change to a safe harbor 401k plan. So the good news is that you do not have to amend the plans for the new Roth rules by the end of this year. You have until the end of next year.
There are several design choices for implementing Roth catch-up contributions that will require coordination among employer payroll and the plan's record-keeping systems. While there are implementation choices, which we will discuss, the choices may be limited by your payroll and record-keeping capabilities. So if you have not already started these conversations, reach out to your record keeper and payroll companies. Under the new rules, a plan is permitted to provide that a participant who is subject to the Roth catch-up mandate is deemed to have irrevocably designated any catch-up contributions as after-tax Roth contributions. This will be true even if the plan generally requires separate elections for elective deferrals and catch-up contributions, or is based on a spillover design. With a spillover design, contributions in excess of the normal deferral limit continue as catch-up contributions. However, each participant must be given an effective opportunity to make a different election, such as stopping catch-up contributions, if they will be deemed to be after-tax Roth contributions. Whether the participant is given an effective opportunity to make a different election, of course, depends on all the facts and circumstances, including the adequacy of the notice, the period of time for which a different election can be made, and any conditions imposed on a different election. Any deemed Roth election must stop within a reasonable period of time after the participant ceases to be subject to the Roth mandate, or after an amended Form W-2 is filed indicating that the participant is not subject to the Roth mandate. In that case, previous Roth contributions do not need to be recharacterized as pre-tax deferrals. For purposes of the deemed election rule, employers have flexibility in how to apply the rule. A separate catch-up election can apply to deemed Roth catch-up contributions at the time the contributions are made, for example, on a payroll-by-payroll basis. If these contributions are later recharacterized as regular non-catch-up contributions, they retain their status as after-tax Roth contributions. A spillover Roth election can apply the deemed Roth contributions election once the participant's pre-tax deferrals reach the annual non-catch-up limit, or once the participant's year-to-date aggregate pre-tax and Roth contributions exceed the annual non-catch-up deferral limit.
Thanks, Constance. Let's work through a short example. Mr. Smith, who had wages of $175,000 in 2025, will have planned compensation in 2026 of $200,000. Mr. Smith can contribute in 2026 to the 401k plan up to $24,500 in either pre-tax or Roth contributions. He also can contribute in 2026 another $8,000 to the plan before potential super catch-ups that we'll talk later. But that additional $8,000 must be after-tax Roth contributions. If Mr. Smith elects to make the maximum pre-tax contributions he can to the 401k plan for 2026, including catch-up contributions, and if the plan provides for the deemed Roth election, the employer can switch his contributions to after-tax Roth once he makes pre-tax contributions up to the full $24,500 limit without asking him. However, the employer must give Mr. Smith a reasonable opportunity to stop further contributions from being made if they would be deemed to be after-tax Roth contributions.
Thanks for these examples. These are helpful to see how the rules actually work. So you may wonder who is subject to the Roth mandate. As we noted earlier, the Roth mandate applies to each participant with FICA wages from the employer sponsoring the plan exceeding $145,000 adjusted for inflation in the prior calendar year. As noted, the IRS announced today that this limit is increasing for 2026. So a participant with FICA wages in excess of $150,000 in 2025 will be subject to the Roth mandate beginning in 2026. Of course, the analysis is never that simple. So let's dig into this determination. FICA wages mean the participants' wages that are subject to taxes imposed by the Internal Revenue Code sections 3101A and 3011A, which is the Social Security tax, not the Medicare tax. Wages subject to Social Security tax are reported in Box 3 of the participant's Form W-2 for the calendar year. So for purposes of the Roth mandate, employers can rely on the wages that are reported in Box 3 of the participant's Form W-2 for the applicable year. This means that a participant with no FICA wages from the employer sponsoring the plan for the prior year, or whose FICA wages are under the threshold for mandatory Roth contributions, is not subject to the Roth catch-up mandate. This includes partners with only self-employed income.
And when applying these rules, the individual's FICA wages for the prior year are determined pursuant to the normal FICA inclusion rules. So, for example, a participant who participates in the employer's non-qualified deferred compensation plan can have FICA wages in a year, even if the participant elects to defer the compensation under the employer's deferred compensation plan. The special rules under FICA for deferred compensation generally tax compensation for FICA purposes when the related services are rendered, or if later, when the right to the compensation becomes vested, or potentially even later if the amounts are not reasonably ascertainable until a later date. So in our example, a participant who participates in the employer's non-qualified deferred compensation plan could have significant wages in a calendar year for purposes of the Roth mandate, even where the participant's salary compensation does not exceed the threshold. The $145,000 wage threshold is not prorated if the participant works less than the full year in the prior calendar year. So if a participant is first hired later in the year, then that participant may not be subject to the Roth catch-up mandate in the following year unless the participant actually has wages in the year prior in excess of the threshold without proration given the employer is employed for less than the full year.
Great point, Jeff. It's also important to note that for purposes of the mandate, a participant's FICA wages are based on prior year wages from the employer sponsoring the plan. So, who is the employer sponsoring the plan? The regulations instruct that we look separately to the participant's common law employer. If the participant received wages from two employers, both of whom adopted the plan, wages from both employers are analyzed separately, not aggregated, even if the two employers are within the same controlled group. Now, this is surprising because wages paid by another common law employer that is treated as a single employer with related entities generally are aggregated for other purposes of ERISA and the Internal Revenue Code. But for purposes of determining whether the individual meets the threshold for application of the Roth mandate, those wages generally are not aggregated. Now, this can be problematic for related employers who have centralized payroll procedures and send a participant a single Form W-2 for all related employers. Fortunately, the final regulations now permit but don't require the aggregation of wages paid by the participant's common law employer with one or more employers using a common paymaster and or one or more employers within the same controlled group. Now, the plan must specifically specify the related employers whose wages will be aggregated for purposes of the Roth mandate. Similar rules will also apply where a common law employer acquires another business in an asset acquisition. The common law employer sponsoring the plan is the key entity for determining the participant's FICA wages, even if the employer's responsibility under the tax code are imposed on a third party, like a common paymaster or a professional employer organization like a PEO. So an individual who happens to work for two entities, both of whom use the same PEO, is not required to have their wages aggregated for purposes of the mandate. Wages paid by an employer other than the employer sponsoring the plan generally are disregarded, of course, with permissive aggregation for related employers and common paymasters.
Yeah, let's keep in mind, however, that a plan is not required to offer Roth contributions. If the plan does not permit Roth contributions, participants who otherwise would be subject to the Roth catch-up mandate cannot make any contributions for the year. Participants who are not subject to the Roth catch-up mandate can continue to be permitted to make pre-tax catch-up contributions, even though those participants who are subject to the Roth mandate cannot make any catch-up contributions due to the plan's lack of a Roth feature. In this case, there's no violation of the universal availability rule. However, the foregoing claim as I could cause issues with benefits, rights, and features non-discrimination testing, which generally requires that all plan features be available on a non-discriminatory basis to non-highly compensated participants. This is because some participants who are non-I's may still be subject to the Roth catch-up mandate, and those non-I's then could be prevented from assessing a plan feature if there is no Roth feature. If this situation applies, however, the regulations do provide some potential relief from benefits, rights, and feature testing, which you can discuss with your appropriate legal counsel. Also, a plan cannot require that all participants who make catch-up contributions do so on an after-tax Roth basis. So the only way an employer can avoid having to determine which participants are subject to the Roth mandate would be to completely eliminate all catch-up contributions in the plan. Of course, if there are more than one plan within the control group and one plan offers catch-up contributions, then all plans must offer catch-up contributions under the universal availability rule. If the plan wishes to allow participants who are subject to the Roth mandate to make catch-up contributions, but does not currently permit Roth contributions, the plan must be amended to permit Roth contributions.
What if the participant wants to make Roth deferrals that are not subject to the mandate? In other words, regular non-catch-up Roth deferrals. Even if the mandate applies, the plan can permit designated Roth contributions before reaching the general pre-tax deferral limit. As long as at the end of the year, a participant subject to the Roth catch-up mandate does not have pre-tax contributions exceeding the normal deferral limit for pre-tax or Roth contributions, in other words, $24,500 for 2026, the Roth catch-up mandate will be satisfied, regardless of when during the year those pre-tax contributions were contributed. The Roth mandate just has to be satisfied by the end of the year.
As we all suspect, there are going to be errors in administering the Roth mandate. Contributions that should have been after-tax Roth will be contributed as pre-tax contributions. Regulations, however, include two special correction options that the employer can use. Provided, however, that the 401k plan must have in effect the deemed election rule, where the participant who is subject to the Roth catch-up mandate is deemed to have irrevocably designated any catch-up contributions as after-tax Roth contributions. So this is one of the reasons why most employers will likely adopt the deemed catch-up rule in order to take advantage of these two special correction options. When correcting a failure, the same correction must be used for all similarly situated participants, but this does not require that all failures during any applicable year be corrected in the same manner.
Under the first option, the participants' pre-tax catch-up contributions that were required to be designated as Roth contributions can be transferred, adjusted for gains and losses, from the participant's pre-tax account to the participant's designated Roth account. And the employer then would report the contribution, not adjusted for gains and losses, as a designated Roth contribution on the participant's Form W-2 for the applicable year. Only the contribution and not any gains or losses would be included in the participant's gross income for the applicable year as the result of the recharacterization. This option is not available after the individual Form W-2 has been furnished to the participant for the applicable year, which generally means the correction method is not available after January 31st of the following year, given that the participant's Form W-2 must be sent to him or her on or before January 31st of the following year.
Under the second option, the plan could do an in-plan Roth conversion of the pre-tax amount, adjusted for gains or losses, and then report the amount as taxable to the individual on a Form 1099-R. In this case, the related gains or losses would be reflected in the amount of taxable income reported to the participant. An in-plan Roth conversion is not limited to plans that otherwise allow in-plan Roth conversions, but the in-plan Roth conversion option must be reflected in the plan document as a method to correct failures to comply with the Roth mandate. The participant is not required to elect or even to consent to the in-plan Roth conversion as part of the correction. Earnings that are distributed from Roth accounts, however, are subject to tax. And unless an exception applies, for example, the participant has attained age 59 and a half, died, or become disabled, an additional 10% tax penalty applies if the earnings are distributed from the Roth account within 5 taxable years following the first tax year in which the Roth contributions are made to the plan. If the year of the in-plan Roth conversion is the first year in which the participant has made Roth contributions to the plan, the first taxable year, which is counted for purposes of this recapture rule, is the year in which the pre-tax deferrals are transferred to the participant's Roth account in the plan as part of the correction. If the failure is corrected under option 1, above, which Jeff talked about, the first taxable year for purposes of this recapture rule will be the year with respect to which the Form W-2 is corrected if that is the first year in which Roth contributions are made to the plan.
In order to use either the new special correction methods, the plan must have in place policies and procedures designed to result in compliance with the Roth mandate. The plan also must have in place the deemed election rule we described earlier. For example, the participant who is subject to the catch-up mandate is deemed to have irrevocably designated any catch-up contributions to be made on his or her behalf as after-tax Roth contributions. This is one of the reasons why we generally recommend that employers amend their plans to provide for the deemed election rule. To use either special correction method, the plan must correct any failure relating to a failure to comply with a statutory limit, such as the annual limit on non-catch-up deferrals or the limit on aggregate contributions that can be made to the plan for the year, by the end of the taxable year following the taxable year for which the elective deferrals were made. And note there I said taxable year, not necessarily the plan year. Any failure relating to a failure to comply with the plan limit or to correct for ADP testing must be made by the end of the plan year following the plan year for which the catch-up contributions were made. Notwithstanding the foregoing deadlines, which are in the regulations, however, most employers will want to correct any failures by the normal deadlines that may apply to the particular type of failure, because these normal deadlines usually are earlier in time than the final deadline for correcting a failure to comply with the Roth mandate per the regulations. Otherwise, there could be additional adverse consequences. For example, if pre-tax elective deferrals exceed the Section 402G limit for the calendar year, i.e. the $24,500, the correction deadline generally is April 15th of the following calendar year. If the excess deferrals are not distributed for the plan by the April 15th deadline, the excess pre-tax deferrals are included in the participant's income in the year made, and again when the amounts are distributed from the plan. So therefore, you can see you'd really want to correct that by the April 15th deadline as opposed to waiting until the end of the year, which is what the regulations would permit. Any pre-tax deferrals that should have been characterized as after-tax Roth contributions and that are distributed before correction will not qualify for rollover as an eligible rollover distribution. There are a couple exceptions to having to correct failures to adhere to the Roth mandate, although they're not going to be readily available in a lot of circumstances. First, no correction is required if pre-tax deferrals that should have been treated as after-tax Roth contributions do not exceed $250, and that's disregarding any earnings and losses on those amounts. So you can see the exception for the correction is a fairly de minimis amount. Also, no correction is required where the participant's FICA wages for the prior year are determined to exceed the threshold i.e. in which case the Roth mandate should have applied, on account of adjustments to the participant's Form W-2 that are made after the correction deadline for correcting any Roth failures under the special correction methods. So for example, if you're relying on a W-2, if that gets corrected after the end of the following year, then you don't have to go back and recharacterize or correct the failure to apply the Roth mandate. You can rely on the incorrect W-2, provided it's not corrected before the deadline.
Thanks, Jeff. Let's switch gears for a minute and discuss the enhanced catch-up rules, sometimes referred to as super catch-ups. Beginning in 2025, individuals aged 60 to 63 by December 31 of the year are eligible to make increased catch-up contributions to their 401k plan for the year. Of course, that's if the plan allows it. These higher catch-up limits apply to 401k, 403b, and governmental 457b plans that currently offer age 50 plus catch-up contributions. The higher age 50 catch-up contribution limit for ages 60 to 63 is $10,000 or 150% of the standard age 50 catch-up contribution limit, whichever is greater. For 2026, the IRS announced that this higher catch-up contribution limit for those aged 60 to 63 by December 31 of 26 is $11,250 instead of $7,500. For the year in which the participant turns age 64, the participant reverts back to the standard catch-up contribution limit, which is $8,000 for 2026.
A plan need not offer advanced catch-up contributions just because it offers the normal age 50 catch-up contributions. However, each catch-up eligible participant who participates in the plan must be allowed to make the maximum amount of catch-up contributions permitted for that participant. So, for example, a plan cannot only permit participants who are aged 60 to 63 to make the special catch-up contributions. Keep in mind that the catch-up contributions are subject to the universal availability rule we discussed earlier. If one plan in the control group offers super catch-ups, generally so must all plans within the same control group, although there are exceptions for collectively bargained plans and employees subject to the Roth catch-up adjustment who are precluded from making catch-up contributions because the plan does not have a Roth contribution feature. With respect to this new limit, some plans have previously defined catch-up contributions by referencing the limit to Code Section 414b7. We've seen in some cases that some employers argue that the plan then will automatically provide for super catch-up contributions by simply referencing Code Section 414b7. However, the regulations imply that the plan should still be amended to permit or prohibit super catch-up contributions in those circumstances. The right to go on to say that terms of the plan need to be clear. So for employers who define catch-up contributions simply referencing the code limit, still need to amend their plan, or we would recommend they amend their plan to either permit or prohibit these super catch-up contributions. Otherwise, you're at jeopardy that the IRS will say your plan is not clear and therefore non-compliant. Constance, why don't you talk a little bit about the special rules that apply to individuals in Puerto Rico?
Sure, Jeff. There are special rules for plans that must also satisfy Puerto Rico Internal Revenue Code, where the plan must be qualified under both the U.S. Internal Revenue Code and the Puerto Rico Internal Revenue Code. The Roth catch-up requirement is deemed satisfied with respect to participants subject to the Puerto Rico Code until the Puerto Rico Code is amended to provide for designated Roth contributions. So wrapping this all up, implementing these discussed changes will require coordination among several parties, including HR, payroll, record keepers, and third-party administrators, especially for plans that do not currently but wish to offer Roth contributions. Advanced participant communications and education is key. All of these items require careful planning and coordination, and plan sponsors should at least be having communications with the appropriate parties now to establish timelines and action items for implementing these changes for 2026. For companies with multiple plans within a control group, they'll need to consider the universal availability rule and coordinate and communicate among those control group members.
Yeah, and I'd like to emphasize what Constance just said. Be proactive in reaching out to your payroll providers. I know a lot of platform providers are sort of working with this and trying to work out their systems, but what's going to be key is making sure that your payroll provider can accommodate whatever design you end up intending to select. I think that wraps up our podcast on Roth catch-up contributions. Remember, as we noted, staying informed and proactive is key to navigating these developments successfully. If you have any questions or need further assistance, do not hesitate to reach out to anyone on our team at Troutman Pepperlock.
Copyright Troutman Pepperlock, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman does not make any representations or warranties, expressed or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepperlock. If you have any questions, please contact us at troutman.com.